Hi everyone, I'm super excited to talk about the Microsoft Deferred Compensation Plan today. My colleague Nick and I have prepared a couple series to provide some guidance on how the Microsoft Deferred Compensation Plan works and when it makes the most sense to think about utilizing this company benefit. In this short video, we will cover the basics of deferred comp, key differences between deferred compensation and your 401k, other important DCP considerations, and lastly, we will go over a high-level example. Before we jump too far ahead, it is important to note that the deferred compensation plan is available to employees level 67 and higher. I think it is helpful to think about deferred compensation in terms of similarities to your 401k. Much like your 401k, contributions to your DCP plan reduce your taxable income. You can invest the funds in your DCP account like you can in your 401k for future growth. The dollars contributed to your deferred comp plan grow tax deferred. At a high level, these two plans seem to function somewhat similarly, but let's chat about a few key differences. Contributions and changes to your deferred compensation plan are much stricter than your 401k. The Microsoft DCP windows are May and November. Unlike your 401k, the deferred compensation plan has different consumer protections. Distributions from your 401k can be pretty flexible, whereas deferred compensation distributions are rigid, and there are strict rules and a meaningful amount of cash flow planning that go into adjusting distributions. Lastly, the IRS sets limits for 401k contributions each year. The deferred comp plan allows for significantly higher contributions. You are allowed to defer 100% of your bonus and 75% of your base salary. As a Microsoft employee, there are some key dates to keep in mind throughout the year. The deferred compensation plan has 2 election periods each year. In May, you are able to make elections for your cash bonus. You are able to defer up to 100% of your cash bonus. With your bonus, it's important to remember that you are making the election for your bonus the following year. In November, you are able to make your election for your salary. You are able to defer up to 75% of your base salary. Your annual stock awards vest in February, May, August, and November. It's important for us to keep track of your stock award schedule because depending on how you choose to optimize your deferred compensation plan, you may need to start thinking about your stock payout differently. We always encourage clients to review their 401k contributions and allocations early in the year. It's important to make sure that you are on track to fund earlier in the year than making large adjustments mid or end of the year. As you can see, there are lots of considerations when thinking about how to best leverage the Microsoft Deferred Compensation Plan. It is important to thoroughly understand your cash flow to help structure your deferrals, and it is very important to have a long-term plan in place so that you can thoughtfully structure your deferred compensation payouts down the road. Next, let's go over an example. Deferred compensation can be incredibly powerful from a tax savings perspective. Let's assume you are a 50-year-old level 67 at Microsoft. Your salary is $250,000 a year with a bonus of $112,000, and your stock vests are around $400,000 a year for a total income of $762,000. If you elected to defer $150,000, which would represent a combination of your base and bonus, you could potentially be saving upwards of $50,000 a year in federal income tax. I hope this information is helpful. Feel free to contact me to learn more about the Microsoft Deferred Compensation Plan and explore if this is a benefit you should be utilizing.